stocks. They are higher today as markets roar back from last week's sell-off. The Dow, S&P 500, and NASDAQ are now hitting two-week highs. Rate cut hopes are driving the bounce that we're seeing, with the latest economic data supporting the dovish case. Also, more Fed governors like Stephen Myron are making their opinions known and saying that inflation worries shouldn't stop a cut.
I don't see an inflation problem. I do see potential risks to the labor market. In my mind, almost all of the inflation excess is a mirage. It's due to supply-demand imbalances in the housing market that were a thing in 2022 to 2024, perhaps, but not a thing now in 2025 and beyond.
So inflation and the Fed and a cut are part of the market story. AI is part of that story. Asset prices moving sky high, part of that story. You know, I'm in the Brian camp on this, and we've discussed it before, where I saw that pullback and thought to myself, you know what, this is a little bit of a healthy correction, and there's nothing wrong with that. But here we are again, stocks are moving up once more.
Yeah, a couple of things to point out. I think the market investors can't make up their mind what the Fed's going to do, because a month ago we were 90% sure there was going to be a cut. A week ago we were 50% sure there's not going to be a cut. Now we're back to 80% sure there's going to be a cut. We're getting a cut. The labor market is cooling too fast. You can't correct that quickly like you can with an inflation flare-up. Here's the thing I'd point to on the valuations. It was a natural, healthy correction, a pullback of 5% or more. Valuations, if you look at the dot-com days, the top three companies that accounted for the biggest market share percentage in the S&P 500 traded at 61 times forward earnings. Where are we today with the top? That seems very high. Where are we today with the top three companies in the S&P 500? 31 times. So this could be a bubble, but I would argue that it hasn't fully inflated yet. We've got a ways to go before we really have to worry about it popping.
I have lots of thoughts. First of all, this buy the dip mentality that's persisted the last couple of years seems to just be continuing. I'm in the camp that I don't think AI is a bubble if these are leading the fourth industrial revolution. And if the AI pie is getting bigger, then everyone can get bigger without taking market share, or that there is more market share to take and let the best man win, and competition and innovation and smart CEOs and smart entrepreneurs and business people will figure it out and innovate, and the pie will get bigger. Another thing, this is sort of a side note, and this will come back to the equity market and the economy, and I'm going to quote the IMF. Take that for what it's worth. I know. I know. But listen, they have good news. They came out with a forecast for the largest economy by 2030. Remember all those fears, and I was one of them, back in 2020? Oh my gosh, China's going to be the world's top economy by 2025. The IMF still thinks that the U.S. will be the largest by $10.5 trillion by 2030. It is still the U.S. We are still the best place to go. Money goes where it's treated best. I'm still super optimistic that the U.S. is that best place. And if those economic projections stand, we're still far outpacing China as the number 2 economy by over $10 trillion in that time span. And so when the gap was closing, it's now opening up again.
That's encouraging.
Which is encouraging. And so I do have so much optimism in maybe it's AI or whatever sort of drives us further. And again, the equity market follows, right? Because it follows growth.
If you took valuations out of the equation, though, and just looked at the fundamentals, revenue growth is at the highest it's been in over 8 quarters. Profit margins at a record territory since 2009. Earnings growth, five consecutive quarters of double-digit growth. The fundamental underpinnings of this bull market are strong. It's just the valuation that comes into question.
I hear you on valuation, but here is what still worries me about this. In a high inflation environment, which we saw under the Biden administration, people were looking to keep up with inflation. So I think they looked at the stock market in some ways to do that. It wasn't necessarily that there was this great underlying growth that Bidenomics was driving. We talk about a lot on this show how more and more people are invested in the market. They've sort of woken up to that if you want to create wealth, generational wealth, you've got to be invested in the stock market. As the number of people that become more invested are participating, there's a positive side to that, but also there's a negative side in that whenever this bubble scenario does happen, a lot of people could potentially be holding the bag. So, you know, I don't know. And I've never seen a market in my lifetime or history that just kept going up, 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 up.
Yeah, it doesn't, because humans are fallible and we get things wrong. The AI, I'd rather be on the side of going full throttle on AI investment than not. I would rather the U.S. be a leader, not sitting on the sidelines. But it is absolutely certain we are getting big things wrong because it's an unknown space. You can't know the future. Nobody knows exactly how AI is going to play out. So there are going to be bets that are wrong. There's going to be capacity built that is wrong. That's okay. It's better to do it and get things wrong than not do it at all. But I do get nervous about the wealth effect spending. We've talked a lot about wealth effect spending here. That's where, when the air comes out of the market, you get spending coming out of the market as well. And now you're talking about compounding the problem of maybe a stock market correction with a broader economic correction. I do get nervous about that. I do think culturally we are living more in a moment now where people feel better about betting in the market and then spending money that they haven't realized yet. And I get it. I'm a little bit like that sometimes too, but I don't think that's healthy. And so I do get nervous about culturally the way we view equity earnings and the effect it has on our behaviors and how much we're banking on that right now to keep the economy going.
That's that.
We're banking on it.
I'm
Like, we're
trying to say
always
the same
talking.
thing, yeah.
Was somebody scolding us the other day because we weren't upgrading our iPhones fast enough? Like, you need to upgrade. Like, no, that's not what drives an economy. That is not what drives an economy. It's work that drives an economy, not me buying more iPhones when I don't need one. Sorry, that's my little Apple scoop.
Having lived through and worked through the dot-com bubble and worked for the first independent, standalone financial publication, internet-based publication that wasn't associated with a newspaper, where people in financial services wouldn't even talk to me because it wasn't a legitimate publication. It is. Artificial intelligence and AI is a revolution, and it is changing the way that we live and work now. With just Claude Opus 4.5 that came out, there's a lot of talk, came out a few days ago, and there's a lot of talk about that it's much better than OpenAI and threatening OpenAI, potentially, just in some of the tests that I've seen. But that doesn't mean that it's still a bubble. And there will be companies that go away. And some of them could go away really quickly. Because there is the spending that is going on just on the data center infrastructure. And I've mentioned this before, you have the largest of the large technology companies that they believe there is a winner-takes-all dynamic. And if they let one company take a commanding lead, they are screwed for a quarter of a century. So they are going to spend not only their cash flow, they're going to borrow money, which they have already started doing. And if you can't keep up with them, like you're looking at, say, and I've discussed this, but look at even Oracle compared to other bigger tech companies. Oracle's bonds not performing well. Oracle is burning cash, tens of billions of dollars more over the next several years. The yields on the bonds that they just issued are have been, I haven't looked in the last few days, higher than almost all investment grade technology bonds. You go down the ladder a little bit and you look at a business like CoreWeave, their bonds, they're again borrowing money. Look at the stock just in the last month.
CoreWeave is, I think, the canary in the coal mine for. It's the worst managed. It was a reseller in the data center space.
Right. So. Again, that. Do you need a reseller? Again,
no, I agree.
Right.
CoreWeave should not have been around.
So
that's why they're trying to acquire
44% loss on that stock in the last month.
Yeah.
The bonds, sub-investment grade in bonds, not trading well. So, and you have this swamp of bonds coming in, that's going to crowd out other borrowers in other areas. So, yes, it's a huge revolution. It's incredible what's going on, but that doesn't mean that stocks will burst, bonds will stink, and other companies may not exist in a while.
No, I don't disagree with anything you said. I look at it this way. You want to call it a bubble, I'm going to call it a boom until it busts, right? You have to monitor the potential canaries in the coal mine. So Oracle's bonds, the insurance to protect on default on those is skyrocketing. That's a warning sign. Meta is actually now spending more than they have in CapEx. Their CapEx spending is more than they have in cash flows. Those two companies are ones to watch. But if you look at Alphabet, Amazon,
We'll debate Google.
Yeah, we can debate
I'll shut
Google,
up about
but
that.
they're not spending at the telecom, like the .com levels of 80, 90, 100% of CapEx. They're about 30 or 40%. So all that to say is there's a heavy investment, and you're right. Human psychology is to overestimate the impact in the short term and underestimate the impact in the long term. So we're getting into that. We're just too optimistic about how great this is.
And in the long term, people swoop in, and the companies that die, there's meat on the bones. People come in and pick that meat, and they build something else. That's the beauty of capitalism. It works when things succeed. It also works when things fail, because bad bets by one person can become great opportunities for somebody else. It's when you abandon that philosophy and don't let anybody fail that you really have the problems.
Well, I'm just afraid when the ones that do fail, you've got all this mom and pop and retail investor exposure. I'm not saying that, that's better or worse than having Wall Street or institutional exposure, but you've got all these people invested. We've brought up this idea before. If something were to happen, like the financial crisis again, is the government all of a sudden going to try to, I'm not saying it should, but make people whole again, because you're going to have a real problem on your hands.
That would
That's
make
the only
things
thing that
worse.
I'm worried about.
You're advising caution. I would tell people very practically, if you own individual stocks, use trailing stops. It keeps you from having to make a decision when to sell. It just follows the stock up. At 20% or a 25% trailing stop, so if that stock ever comes back, it automatically sells for you. You don't have to sit there and hold it 50, 70% on the way
The
down.
debt's going to wind up in pension funds. That's where it's going to be.
Oh, yeah, there's a lot of private demand for the debt continually in the data center space.